Hello, everyone. Welcome to today's workshop on valuation, company valuation for fundraising. This has become an institution at the Resi conference. Our friends at Venture Valuation in Switzerland have been working on these topics for many years now and have been collaborating with the Resi conference. So we're very happy to have them here. We have Patrick Fry, who's CEO at Venture Valuation, and we have Gary Ivany, who will be presenting today. If you have any questions, feel free to write them in the chat box or in the Q&A tab, and I'm sure that they will be happy to address them. So, Patrick, it's all yours.
Perfect. Well, good morning or good afternoon, wherever you are. Welcome to this workshop on company valuation for fundraising. Thanks for the introduction, Greg and LSN. We're always happy to participate and talk about valuation, because obviously that's something that we are working on every day, and we understand this is a big topic for any company raising money and talking to investors. The valuation side is not the only thing, but it's still an important part. So what we would like to do, we'll talk about valuation. Gary will start afterwards, just giving you a little bit of trends and background, what's happening in terms of financing, what we see. And I give you a quick introduction now about venture valuation, what we do. And then I'll talk about valuations and how to do it, and what kind of tools you can use, and what's important afterwards. So very briefly, why do we do these valuation courses or workshops? Well, we've been doing valuation of biotech and pharma companies for the last 22 years. We started in '99. We started in Switzerland. We're still headquartered in Switzerland, but we do valuations all over the world. Is really the US, Canada, all over Europe, Asia, and all the way New Zealand and Australia. We really do valuation wherever there are life science, biotech, pharma companies. And we are a team of 35 people, and also in different parts of the world. So it reflects a bit where we are active. Europe, US, and also in Asia. And we work a lot for companies who raise money, because they need to know, and you need to know what's the value of a company, and also what can you do to make it more attractive to investors, to make the company more valuable. So we work with the companies, but we also, 50% of our clients are actually investors. And Novartis Venture Fund was our first client when we started. We work also for VCs. We work for family offices, business angels, sometimes universities, but also, as I said, a lot of companies. Beside the valuation part, we also run Biotech Gate. That's a global business development database. And here also what Gary will present is coming from this database. When we did valuation, we realized you need a lot of data. So we started this database also about 16 or 17 years ago. We track financing rounds. You will see the numbers that we can present. So what kind of trends, who is investing. We look at licensing deals and deal terms. We look at clinical trials, and we look at assets. So we are also very active in that. And that's obviously also a great source for information. Good. This was a quick introduction from my side. Now this is what we will go through. So an overview of the biotech financing trends. Gary will present that, and then I will go through some topics when you talk to investors, that are connected to valuation, and hopefully give you a bit of an overview, what is important when you speak with investors. Good. Then I would like to hand over to Gary and present a bit the trends.
Yes, thank you, Patrick. And thank you for the introduction, Greg. So I would like to also welcome everyone on the company valuation for fundraising workshop. My name is Gary and I work as a business analyst at Venture Valuation. My goal today is to provide you some context for the valuation workshop, as Patrick said, by discussing recent financing trends. So first, I'm going to show you some aggregated financing data of private equity rounds, IPOs, and post-IPOs. Then we will go more into detail and have a look at these financing rounds separately. As Patrick said, the data we analyzed comes from Biotech Gate, our global life science database. So let's start. First, to provide you some context, we plotted a 10-year chart of the capitalization-weighted Nasdaq Biotech Index. This is shown in orange on the chart. So if you look at this, you can see that in the first part of the decade, there is a steady increase up until 2015, as the underlying companies were becoming more and more valuable. This first rally stopped in 2015, and then it took 5 years for the Nasdaq Biotech Index to return, and then to exceed the levels of 2015. Among others, scientific advancements and the COVID-19 pandemic put the industry under spotlight, and this contributed to the recent increase of the NBI. So next to the Nasdaq Biotech Index, we plotted the aforementioned sum of private equity rounds, IPOs, and post-IPOs of biotech therapeutics and molecular diagnostics companies to see how much capital went into the sector year by year. So adding everything together, the amount of investment into biotech was almost 14 times more in 2020 than in 2011. Furthermore, we can see a sharp increase in the amount of investments starting from 2016, and the curve gets even a slightly bit steeper approaching 2020. On the next slides, we are going to take a closer look at financing rounds to see which region drives this growth. So this chart shows the total private equity investment between 2015 and 2020, broken down into geographical regions. Since 2015, worldwide private equity investment has more than tripled, going from about $8 billion to about $26 billion in 2020. This upward trend is primarily driven by US-based companies, which managed to secure more than $16 billion in 2020, about twice as much as companies outside the US. In contrast, annual venture investment into biotech, European biotech, stagnated between $2 and $3 billion, breaking above $3 billion only in 2020. We see investments into Chinese biotech companies is growing at the fastest rate. We can see that investments in 2020 were about 18 times more compared to 2015. Now let's take a quick look at the IPOs. Next slide, please. We can see that IPO trends are very similar to private equity trends. Between 2015 and 2020, worldwide IPO investments about quadrupled. Furthermore, we can see that the amount of capital raised in 2020 was about 2.6 times more than in 2019, which was driven by Chinese and US biotech companies. Unfortunately, we cannot say the same about European biotech IPOs. Whereas for other regions, 2020 was the record year, European biotech companies actually managed to raise more money in IPOs in 2017. And also similar to private equity, IPO investments into Chinese biotech companies are growing at the fastest rate. Chinese biotech companies managed to secure about 50 times more financing in 2020 than just 5 years before that. The most valuable scene for IPOs remains the US. Here, companies managed to raise almost twice as much in 2020 as the rest of the world combined. An interesting trend to mention in the US are the SPAC IPOs. So SPACs are special purpose acquisition companies, which are set up with the sole purpose of merging with another company, and so bringing that company public. Thus, SPACs serve as an alternative to IPOs, and they are also regulated slightly differently. SPACs have been around for many years. However, in the past few years, SPAC IPOs were gaining significant traction. In May this year, the Financial Times reported that the SPAC bubble of 2020 and early 2021 started deflating, and we can only wait and see how this trend is going to continue into biotech. So next slide, please. So here we can see the average value of private equity or a public financing round. Looking at the private equity rounds, we can see that the average value of each A, B, C, D, and E rounds almost doubled or more than doubled between 2015 and 2020. On one side, this might indicate the greater capital requirements of drug development. And on the other side, this might also show that the funds are becoming bigger and bigger, and investors are willing to pledge more money into each financing round. So among the rounds, we can see that on average, the most valuable round is Series E, and the value of the rounds decreases as we go down the ladder. Looking at public financing, biotech companies could raise more than twice as much in 2020 as in 2015. So in 2020, the average size of an IPO was about $185 million, and in 2015 was only around 71 million. Likewise, post-IPO financing has also increased in this period. So in summary, we can say that biotech companies could raise more money in 2020 than ever before. Lastly, let's take a look at the most financed indications of 2020. So So this chart displays the distribution of VC financing in 2020 between various indications. We can see that most of the VC financing went into companies with oncology product in the pipeline. This was closely followed by infectology, no surprise there because of COVID, and then neurology and endocrinology. Compared to last year, the big change was in the financing of infectology, as mentioned before, because of the COVID-19 pandemic. So, and lastly, if you would allow me to speculate a little bit, I would say that neurology will most likely remain one of the most favored disease areas of 2020, thanks to the recent FDA approval of the first disease-modifying drug in Alzheimer's disease. It was also really interesting to see that on the day of the approval, the Nasdaq Biotech Index gained around 3.6%, showing the importance of breakthroughs and that they're not only important for the individual companies, but also for the whole sector. So with that, I would like to conclude our overview of the biotech financing trends and hand over the presentation to Patrick.
Great. Thanks very much, Gary, for this insight into what's happening on the financial side. I think the overall message is pretty clear. There is money around. I think the sector has definitely benefited from the last year or 2 years from the crisis. There, as Gary said, there's a spotlight on the pharma and biotech industry, and I think we can see that now also in the numbers. So I think good projects, we see that they are able to raise money. So it's a good time to go and talk to investors. So who is the right investors? What should you and should you not do when you talk to them? And also, how do you value your company? So that's what I'd like to cover in the next, maybe 30 to 45 minutes. So, I mean, one of the things, obviously, fundraising is a challenge. It's not easy. It takes time and it takes money to raise money. There is, obviously, we have higher costs for development, or the costs are very high. The hurdles for registration it's not going down. It is, it is challenging. You might be asked by the FDA to do additional trials. So the hurdles are still very high. Investors get disappointed. In the past, we have a group of investors that have maybe not made that much money or have been disappointed. And depending on investors, also there's a certain risk aversity. So it depends to whom you talk and how much risk they're willing to take. But overall, it is a challenge, but there is funding available, as we just saw. So what can you do if there's VC, but there's also other opportunities to raise money, and not everybody should go to a VC. We will see that afterwards. It depends on the type of company you have. It depends on how much money you want to raise. And you might want to talk to different types of investors. Life Science Nation, they have this database, the investors database, where you find, for example, family offices or corporate investors, and maybe not your typical investor, business angel. So, it's important to think about the different possibilities. So what we see, definitely family offices, that has been and has increased dramatically in the last 5-10 years, as family offices are directly investing into companies or through funds, but they have been much more active, and it's definitely a growing source of capital. Also, corporate investors, I think that has been for a number of years, but I think they also play a very important role, corporate investors, and are an interesting source of capital. What we've also seen, a lot of companies coming out of being a service companies and going into the innovative, product development, the drug development part, or spin-off. You have a company that is a service, a CRO, and they spin off a drug development company. So they are able to finance part of their research and development, at least initially themselves, from the services that they provide. We've also seen kind of very specific project or product financing by VCs or by other investors. So they don't invest in a already ready company, a diversified company, but they invest just in one product. They might bring in management specific for that product. So the question is also where is the diversification happen? Is that on the fund level or is it in the company level? And it's something to think about. Who requires what kind of diversification? Then obviously public money. We have different grants that you can get, non-dilutive funding. So I think the public sector, we tell companies try to get that if you can. Obviously, there's always a trade-off. If you have to change the strategy or your product into a different direction just to get funding, you have to think about it. Does that make sense? But at the end, you want to talk to investors who are looking for what you have, right? So it's important to identify the right investors and think about who you want to target and why. So, you can do your own development with your own financing because you have services. So you have your internal financing of your product, and you do grants from government funding, regional, national, international, or you go out and raise money. You can get equity or you can get debt, to a certain degree, depending on the company. You can do convertibles. So there's different sources of financing, and different instrument that you can use. Now, here, what I try to do, just give you a little bit of an overview. And one of the things is, when we talk to companies and we do valuation, if a company raises below 5 million, it's very difficult to go and talk to a venture capitalist. And you have to, the background, basically a venture capital fund, if they have 100 million, if they make 1 million investments, they will have to look, or due diligence on at least 100 companies, they will do probably 10 times that much. But if they invest 10 million, then they do 10 times less due diligence. So for them, they have a certain interest to invest a certain amount, right? Because they have the size of the fund, they have also the certain resources available. So if you go to VCs, 5-10 million should be the minimum size that you're raising, because otherwise it's just not interesting for them. Also, investors, obviously, they're used to take risk, right? They're going for high potential, high risk, and typically the capital requirement would be higher, and they have an exit. They want to exit before they even think about investing. They already think about how do they exit the company. So for them, a clear exit strategy is very important. If you can provide them possible exit strategy, that's helpful. Now, if you talk to corporate investors here, the size might be a bit less of an issue, depending on the corporate investors. If they have a strategic goal and the strategic background of the fund, they're more open to invest at the beginning also smaller amounts, because they want to be in there. If you have a new technology that they want to be part of, they will be more open. So for them, it's more a strategic fit. They want to invest in really innovative companies. And here exit is a possible acquisition, obviously. So that's also interesting working with a corporate investor, because you have possible exit route. Family offices also here. You have different types of family offices, such that invest only higher amounts, but typically they would probably be also open to smaller amounts. What we see is of family offices sometimes also they're open to invest in companies with a service component. They're a bit more opportunistic. Maybe the capital requirement is not so high, and they have a more long-term view. They don't need an immediate exit, because they don't have a limited lifetime of the fund. And then business angels, typically they would be involved in smaller size investments earlier on, depending again on the business angel. But here you have smaller tickets, smaller fundraising, and then obviously capital requirements that are smaller. Now, when you talk to these type of investors, what are maybe the do's and don'ts? Just from our experience, when we work with companies, as I mentioned, we help on one side, we help investors who invest in such companies, and on the other side, we help the companies who are out there raising money, talking to investors. So I always tell people we are Swiss, we are neutral and independent. So we see a bit what works and what doesn't work. And I'm just trying to bring that across here, just from experience, what we see. If as a company, one of the things we often see is that companies start way too technical. When you pick your project and you have a limited amount of time, even if you do these Resi conference, you do these one-on-one meetings, you have a limited amount of time, to go into all technical details. Often the founders they feel very comfortable with that. But for an investor, they want to know that, they want to know the science, but they want to know the business side as well. So it needs to be a combination. And in a first meeting, don't go too technical and too detailed. There's still time to do that afterwards. You just want to get the investor interested. Then don't be too vague and unsubstantiated statements. We are the best. There's no risk. We will have a $20 billion sales. You have to really underline your statements. Then don't ignore or underplay your competition. To have competitors means there are other people also see a potential. So that's not necessarily bad. Give a fair comparison, what others can and cannot do, and make it better. But don't underplay your competition. Then don't ignore risk. I've heard too many times people saying, we don't have any risk. There's no risk involved. This is a risk-free investment. Yes, that doesn't really happen in biotech. So there's risks everywhere, and it's better to talk about the risk, put them on the table, and also talk about what you do to mitigate these risks. Then funding, it takes time. We mentioned there is money around, but it still takes time. Don't wait until the last minute. Start talking to investors when you don't need the money. The best thing is to talk to investors, and you can tell them, you know, this is what we do, this is what we have. We don't need money at the moment. That's it. If you talk to them and say, well, you know, we need the money tomorrow, otherwise we're going to go bankrupt. That's not a good position to be in. Don't race between significant milestones. Make sure you raise enough money that you get really across the bridge to the next milestone. If you get short, and you know, things always take longer, cost more. So if you don't have enough money, you have to go and raise money before you reach this next milestone. That's not a good position to be in either. So make sure you raise enough money. Don't be afraid to ask for the funding that you need and a little bit more. Because again, you don't want to be short of just achieving a major milestone. So the do's when you talk to investors, well, you need a business plan. Again, that's something we've heard. Well, we don't need a business plan. You know, it's all in my head. Well, for the investors, they can't see in your head. So it's good to have it on paper. We all know that the business plan is probably not going to play out as the way that it was written, but I think it shows and puts things in perspective. It shows the investors that you have thought about it. And you know, sometimes when we talk to companies, you know, they come up on the fly and change the strategy. And having something in writing in a business plan, it shows really you've thought about the strategy. And it's not something because yesterday somebody mentioned another new indication, suddenly everything changed and you go suddenly that direction. So I think it's good to have a business plan and have that written. And you know, at the end, the business plan shows an investor how much money you need and where you're going to spend it. Be specific. You know, use market data. Use maybe other companies, other products on the market to show how the market looks like, how a product developed. You know, make references to other projects and market data. Have summarized and structured financial information. If you have several products, I mean, at the end you have to show how much money you need to spend on each product, and that has to be aggregated, and you have to show in total how much money you need. You will need some money for general expenses as well, but it has to be linked. So that's important. It might seem obvious, but there's so many times we have seen that this is, you know, it doesn't fit together, and that also doesn't leave it the best impression. And show how much money you need and how you spend it. I think that's important. Network like crazy. I think at the end, you need to talk to many different people. You only need one investor, but you need to talk to 100, you know, to get to the right one. So you have to network. You have to go out there. That you participate at Resi. That's great. Go to such conferences where you are able to meet. You know, at the moment virtually, but then it will be back, you know, face to face at some point. So stay in touch and contact people. And again, you know, if you talk to investors when you don't need the money yet, that's the best time. Don't wait until you absolutely need it. Develop relationship with them, connections before. For investors, they will not hear from you and tomorrow they invest. They would like to see how companies develop over time and feel comfortable that they achieve what they said they would. And you can always do a reference check on investors as well. You can look at what kind of portfolio they have invested and call these CEOs and talk to them and ask them. Investors will do the same. They will do reference checks on you. Why don't you do the same on the investors? Now, how to do valuation? Again, that's obviously one of our main topics, and so what I'd like to do, just give you a bit of an idea of how, you know, the different valuation approaches work, and for you to get an idea. Now, one of the main things when we talk about valuation is the difference between price and value. And I've heard many times when people say, "Well, I raise money, but why should I do a valuation? I just go to the investor and he will tell me how much I'm worth." Well, I think that's not the best starting point when you negotiate or have a discussion. And I tell people it's similar as if you sell a house, right? If you sell a house, you want to know what is the value. You want to get maybe an appraisal on the house. They give you a range of value, a value range, but at the end you go out and you get different offers, and the price might be higher or might be lower, and that people are offering depending on supply and demand. So the value is really the worth of something, and the price is really dependent on supply and demand. It depends on the market. So Warren Buffett put that once very nicely. He said, "Price is what you pay and value is what you get." So when we do evaluation, we're not setting the price. What we try to do is give a value range. What is a fair value range of a company or a specific asset? And that is then used to negotiate, to discuss and find the price that an investor is willing to invest into the company. So that's an important aspect when you talk about valuation. Now, why do we do valuation? Well, the most obvious reason here, as you can see, a company is trying to raise €500,000 or US dollars. And the question is, for the investor, how much equity will the investor get for his investment, his or her investment? There's different ways to do that. An investor might say, okay, if I give you €500,000 or dollars, I would like to have 25% of the company. With that statement, he implies then a pre-money value of 1.5 million or a post-money value of 2 million. So post-money value is the value of the company after the investment. What we typically try to do when we do evaluation, we try to come up with the pre-money value. So in this case, we could do evaluation of the company. If we come up with a value of 1.5 million, the investor would get 25% for his or her investment. So this is the most typical case when we do valuation. At the end, the question is the percentage that an investor will get. But if we look at it from a more holistic approach or view, evaluation, most of the time it's more than just getting a value. It's really looking at what are the value drivers, what can you do to increase the value, what can you do to increase the attractiveness versus potential investors. And sometimes also it helps a company when they go and talk to investors. They have a third-party valuation, and they, it gives more kind of a starting point. It gives more confidence talking to investors because you have clearly shown how you come up with this potential value range. Now, in general, valuation of life science companies or particular biotech therapeutic companies, people say it's more an art than a science to do that valuation. And some people even say it's more black art, but I leave that up to you. But what's important to know is that traditional valuation methods, they don't really work. Now, a PE ratio, price earning ratio, right? You need to have earnings. Well, the companies we value, they don't have earnings, they don't have revenues, they just have costs. So also an asset valuation, well, the asset is intangible assets, but it's not a manufacturing plant or so we can't use these traditional methods. But then valuation is very important for the development of biotech companies. Typically, you would raise several rounds of financing. So you want to be able to increase the value over time. You want to see what could be an exit value. So if you start too high, it's very difficult to increase the value further, right? On the other side, if you start too low, you get diluted very quickly. So valuation is an important aspect. We have complex technology and IP situation. So it all makes it very difficult because we have very high uncertainties and we have long investment cycles. It takes a long time until we get a product to the market and we start having revenues. So it's very difficult. So it's high risk, but it's also high potential. But this all makes it quite challenging, and it's probably one of the most difficult things to do evaluation of a biotech company. So what's important maybe also to see what is the mindset of an investor when you talk to them. Now, investors typically, they would like to have a high return and have a low risk, but they know that they have to take risk, but they are looking for high returns, right? They're not going to invest in a bakery around the corner, which makes $1 million revenues this year and $1,050,000 next year, right? They're looking for this high upside, high potential, and they're willing to take the risk. Typically, they have their own pressure from their own investors, because a VC actually has to go out and raise money as well, because the capital is at the end, it's going where there's interesting risk return. So at the end of the day, it comes back to what is the risk and the return. So it's a combination of risk return. If you invest, for example, in a government bond, in a 10-year US government bond, your probability that you don't get your money back is 0. It has never happened. It might depend on the country. Other countries might be a little bit different, but in general, your risk of failure is 0, but your return is either very low or close to 0, or in the case of Switzerland, we have negative interest rates. So the government will give you less money back in 10 years because we have negative interest rates. But that means because it's very secure if you buy government bonds. If you buy a normal bond from a company, your risk is a little bit higher, but you demand a bit higher return for that. If you invest in a blue chip listed company, and there's a higher risk, you get equity, so you would be the last one to get the money back. So as an equity holder, you would also require a bit higher return. And if you start investing in biotech companies, the risk of failure, the risk that the company might not be around anymore in 5 years, is even higher because we have very high attrition rates. So the risk is extremely high. So investors want to be compensated for that. The VC invests in 10, and he knows that some of them will not make it. So they will ask for a higher return. So there's the risk return is very important when we talk about valuation. I see there are already some questions. I will go through the presentation and then come back to the questions at the end. So risk is a major factor. The question is now, how can you measure, how can you capture the risk? And that's probably also one of the most difficult things. When we do evaluation, we typically spend quite a bit of time with the management of the company, either face-to-face or we do it through video calls. And we have scientists in our team, people with pharma background, pharmacy, pricing, reimbursement, regulatory side, but also the business side, understanding how does the market look like, what kind of competitors are there. So it's important at the end of the day to understand where are the risks, and for that we do an assessment of the company. And we try to quantify the risk, the different risk factors, because these are soft factors at the end of the day. So what we try to do with this assessment is really understand what are the fundamentals, also to see what drives the value of companies. And so we do an assessment of, we look at the management team, we look at the market, and we look at the science and technology. So these are the main 3 areas that we do the assessment of. And if you do a company valuation, we look at these 3 aspects. If we do an asset, the product valuation, the focus is typically more on the market and the science and technology. But we try to have a framework that we use when we do evaluation of a company, that we always look at the same aspects. With this assessment, what we then do with this rating, we translate that into a number, and it is translated into the discount rate. So for non-therapeutic companies or platform technology companies that we value, this is all transformed into the discount rate. And basically, at the end of the day, the higher the risk, the higher the discount rate. And the higher the discount rate, the lower the value of the company. So what can you do to increase the value? Well, you can reduce the risk. That's one way of trying to increase the value. If we do evaluation of an asset, of a product, a therapeutic product, we use an RMPV, risk-adjusted net present value calculation. Here, the risk is in two different factors, but also here we have a discount rate, and so we assess what are these main risk factors, and this is translated then into the valuation. We probably could go into a whole, detail, do a full day workshop on RMPV, risk-adjusted net present value. That's probably a little bit too much today, but I just wanted to show you how we try to translate this assessment and also into numbers. Now, what kind of tools are there? What kind of approaches to do valuation? At the end of the day, if you can ask 5 different experts on valuation, and you get 6 different answers. So unfortunately for you, there is not one formula that you can use, and everybody uses it, it gets the same value. It doesn't work like that. There are different approaches, different ways to do valuation. People typically take the valuation approach that is most favorable to what they want. And this is always a bit of a problem with people do valuation who have a certain bias. What we try to do, we try to be Swiss, neutral, independent. And when we do evaluation, we try to be, this third party, look at it from an external view and provide a value range. And if you do the valuation for the investor or for the company, the value should be the value range should be the same. So there is an operation-based method. So you more base it on the business plan, on fundamentals. And there are market-based methods where you look at prices, trends, more comparables. So I mentioned before, depending on the company, we use discounted cash flow valuation for platform companies, for service companies. For therapeutic biotech companies, we use more RMPV calculation, the risk-adjusted net present value calculation. On the other side, there's the market comparable or comparable transactions. So this is either compare with publicly listed companies or with private companies that got a financing round or an M&A transaction where we know the price that was paid. There's also a method called venture capital method where we look at an exit price, and I'll come back to that. But at the end, what's important is there is no right method. And what we do when we do evaluation, we try to do the different approaches. We typically use 3 to 5 different valuation method approaches, and that gives us a value range. And each method has advantages and disadvantages. And it can tell a different story, if the market is overvalued or undervalued. So you are able to see from these different methods, a certain, also maybe in terms of how the market looks like, or it also allows you maybe to adjust certain things on the strategy. For example, with the venture capital method, you try to see how much money you will need to get to an exit. And sometimes you can also see there's too much money needed to get to an interesting exit, and there might have to be a shift in strategy. So it's a combination of different methods. So very briefly, discounted cash flow, what do we do here? We try to see what kind of profits can a company generate in the future and see what is the present value of those. Again, if you have a biotech company that is investing the next 7 years, that's more difficult because you have losses and your benefit, your profit will be 7-8 years down the road. Makes it a bit more difficult. This approach is more used for service companies, platform companies where you have maybe near-term revenues and profits. The RNPV calculation, risk-adjusted net present value calculation, it's the fundamental approach is the same as the discounted cash flow. But here, typically, we look at the lifetime of a product. We look at as long as the patent exists, and typically 3 to 5 years beyond patent expiry. So you want to see what kind of revenues can this product generate? What kind of cost does it have in the development, the next year, 5 years? But then what kind of potential revenues can it generate? And again, we try to see what is the present value of that. Now, on top of that, we then use a risk adjustment. So what is the probability that the product will make it all the way to the market? The probability that the product will be successful in phase 1, phase 2, phase 3, and then get market approval. And these are rates that we can use. So just very briefly, this is the risk adjusted net present value. Again, this is more for therapeutic products. Now, the comparable method here, what we try to use is ratios. A P ratio is such a typical comparable method, price earning or enterprise value, EBITDA or sales multiple. Now, unfortunately, for biotech companies, there is no earnings, there is no positive EBIT, or there is no sales. So we try to use different types of ratios. For example, investment in R&D, number of employees, how much money a company raised, what kind of products a company has, and what stage of development. Now, if you have a company that's valued at $50 million, publicly listed company, they have 50 employees, and we have a similar company with 10 employees. Based on the employee ratio, our company would be worth now at 10 million. Now, you can already see a problem with that, right? You just hire more people and you increase the value. Also, if you have on one side a virtual company, right? The 10 employee company might be a virtual company. It should be similar to the publicly listed company, 50 million, which has 50 employees, who does everything in-house. So the value should be the same, but based on that ratio, it's not. So you can already see you have to be very careful in choosing the right comparable companies. But on the other side, it still gives a good impression, a good idea what such value could be. And I mentioned our first client was Novartis Venture Fund. And when I talked to the CEO of the fund at the time, he said, you know, when I look at the company, a biotech company, I just, in terms of valuation, I put 1 million per employee. That gives me an idea what the value could be of the company. But then he added, but I'm not telling the company what currency I use. So he left it a little bit more open. But anyway, this was a rule of thumb that he used just to get a first idea what the value could be. Now, the next approach, it's called venture capital method, and this reflects a bit the thinking of investors. Investors, as I mentioned, you know, before they invest, they already think about an exit. Now, if an investor thinks he can exit the company, he sells the company, sells his shares in 5 years for 100 million. He's not going to pay 100 million today, right? He is taking a risk and he wants to have a return over this 5-year period. So here, what we try to do is we start with trying to estimate what kind of exit value can a company get in 3 years, in 5 years, when you reach certain milestones. And then from there, calculate back what would an investor pay today if he still wants to make a certain return. And this return depends on the risk that he takes. So this is a very good approach also, I think, for you if you are a CEO of a company. You know, if you have a value in mind today, you know, you can kind of see where you need to go in 3 or 5 years, you know, in terms of exit. Or you do this the reverse and see, okay, what kind of value can we generate in the future and calculate back. So that's it's a very good cross-check, in terms of the values and making sure that you have realistic views that also then fit with expectation of investors. Now, just to kind of wrap up or conclude before we come to the questions, you know, at the end of the day, I think one of the things, what's important, think outside the box, right? How you approach investors, you know, where you raise money, to whom you talk, you know, be creative at the end of the day. You know, use databases like Life Science Nations Investors Database, identify the right investors. It's a numbers game at the end of the day. You need to talk to 100 people to get to the right one. You cannot expect that you talk to the right one in the first meeting. Also, until you have the money in the bank, you know, I've seen that so many times where companies that talk to investors and they're promised the money, and then there's a delay and there's this and that. And a year later, they still haven't gotten the money, or the investor suddenly had an internal decision that they now decided not to invest. And then you have to start from scratch. So make sure that you line up enough investors and keep this going until you really have the money in the bank. And it is a numbers game. Then use grants, use non-dilutive funding where possible, but keep the focus. Don't let yourself being distracted just because there's money in a certain area. If it doesn't fit with your company strategy, then stick to what you believe is the right strategy to go for. Valuation is all about assumption. I always tell people, I can do any valuation you want. It's all about the assumptions that you take. So when we do valuation, we always have to try, you know, you can argue any assumption and try to push it to the limit, and then you will get a very high value. And for the investors, the same thing. You can argue down all the assumptions and you get to a low value. So when we do valuation, we try to look at the big picture. And sometimes on one, you have to be a little bit more bullish, but on another assumption, you have to be maybe a little bit more careful. At the end, it has to balance. But it is, at the end, it comes back to the assumption. It's not the calculation. The Excel calculation anybody can do. That's really the easiest part when doing valuation. Then remember, there's price versus value is not the same thing. You know, you can do all the valuation you want. If you don't have a potential buyer, you know, there's no use. Valuation will give you an idea what is a fair value, but at the end you have to talk to the potential investor, agree on a price, and it's more than just the investment, right? At the end you are then in the same boat. So it's important that you choose your investor not just on the financial aspect. It also, you have to work together in the future. And this other aspect now, what can you do to increase the value? Well, you can always try to find potential additional upside, but on the other side, try to reduce the risk. What can you do to reduce the risk of your company? Well, you can try to, obviously, you move a product forward in clinical trials. That's reducing the risk, but it's also the risk in the eye of a potential investor. If he doesn't trust you, if he thinks you're hiding something, his perception of the risk is higher. He is less willing to pay a higher price. So I think here it makes sense to be open and transparent about potential risk, and try to reduce the risk for potential investor, and with that you will be able to get a higher value of the company. With that, I'd like to close. I think there's a few questions. I put this presentation on our website, on venturevaluation.com in the resource center. So if you like to download that, probably tomorrow it should be there. So you can download it. And I think LSN will also post and save the presentation, the recorded presentation, which is also available. Good. Then yeah, I just wanted to see if there are any questions. I don't know, Gary, have you been able to have a quick look? Maybe you can already answer some.
Yes. So the first question which came in was regarding the value inflection points, and I think you already touched upon this with your very last remark regarding the risk, and maybe we could talk a little bit about how we think about risk in probability of success and discount rate?
Exactly. So I think here these milestones or the inflection point. I mean, it's clearly if you move one product from phase 1 to phase 2 to phase 3, this is for a therapeutic biotech company, biotech product. This is how, these are the value inflection points. I mean, these are really the key, the big ones. There's always smaller ones as well, but I think these are really the big ones. And it's often quite binary, right? In terms of either you achieve and you're successful in a clinical trial and you move on, and you drop that risk, or you don't, and then typically you would stop. And the discount the discount rate that actually represents other risks. So this is risk that is not directly linked to the product development. And typical risks here would be, for example, IP risk. It would be manufacturing risk. It would be financing risk. It would be business development risk, partnering risk. So these are all risks that are not directly linked to the product if they're successful in a clinical trial or not. And so we include this type of risks in the discount rate. So that's how we kind of, when we do valuation, we use this approach to do the valuation.
Exactly. So just to conclude, there are two types of risk. One is the product-specific risk, which goes into the probability of success, and there is non-product specific risk, which goes into the discount rate. And yeah, so I think we can go to the next question. VCs typically want to drive the valuation to match their investment thesis. How does a company find a fair deal based on valuation established by a third-party organization like yours? Yeah,
so what we do is really we work with the company to see what is a fair basis, fair value of the company. And obviously VCs have a certain interest, as does the company. A VC would like to, buy low, sell high. At the end of the day, that's how he makes money. But I think a good VC understands also there's value. And what we try to do is provide the company a tool, a set of tools, talking to investors and providing what are the values of other companies. What is the RNPV? Where are the risks? But also where is the potential? But at the end of the day, it is a discussion. But our goal with our evaluation is really to provide a tool for the company to have the discussion with the investor, and also maybe an investor sees different risks, sees additional risks. But with the valuation, you can actually identify where these risks are.
Yes, and the next question was regarding an advanced stage preclinical therapeutic company, and if we would consider results from other multiple animal models and other type of results in our risk assessment. And yes, this is what we typically do. So we have benchmark numbers from various publications, and we always take a closer look at the market and look at the results in the market. And then based on the benchmark numbers and the company's specific results with the product, we can adjust the risk factors.
Yeah, exactly. So we do include it, but obviously, it depends how important it is to get to this next milestone. But it's definitely something we look at. And as I mentioned, when we do evaluation, we have people like Gary, looking at it from, we look from the science side, but also from the business side, to understand the impact of the different animal models that have been used, the result of trials. We also look, for example, if there's biomarkers, that also has an impact, that can have an impact. So we really look at it from different perspectives and see the impact on the risk and the risk going to the market. Good. Then just in terms of time, there was a question, go back to the slide with the discount rate and multiples required per stage of investment. This is this slide. Again, I will save the slide as a PDF. You can download that from our website. I mean, this is just some multiples that VCs typically look for over here is a 5-year period. That's a language that investors use. 3-time, 5-time, 8-time multiple that they achieved. So the higher the risk, the higher the potential multiple has to be. So, but again, that will be saved, so you can have a look at that. And we also have our emails on the presentation. If you have any question, you can contact us. Obviously, we can't give a free valuation for you, but we can always, if there's any questions, we're happy to answer. Good. Then I think we will conclude here. We are, we are Swiss, so we want to make sure we are stopping on time. So just at the top of the hour. So I think from our side, thanks very much, everybody. Have a good rest of the Resi conference. Use these conferences. There's another one coming up, I think, in September. So this is definitely part of the network that you should do. So maybe I see some of you in the next conference. Thanks very much from my side, and have a great rest of the conference.
Thanks very much, Patrick and Gary.